And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning, welcome to the show. It's, of course, Tuesday as we get this week going here, and we're going to get there, right? Heading up towards the end of the week. Monday's Memorial Day, right? Monday is Memorial Day, so you've got a long weekend coming up. There you go. So, important. So, remember the difference, right? We talk about this every year. Memorial Day, those who have fallen in battle. Veterans Day, our living veterans. So, Monday is a very solemn day. So, while you're having your barbecue, just remember we're remembering those that have fallen, defending our freedom. And that's a very important thing these days because it's getting forgotten. Why we have the freedoms that we have. You know, you can run around, shoot your mouth off, say anything you want. That's awesome. That's because somebody died for you to do that. Other countries, you can't do that. So, a couple of things. Couple of speeches out yesterday from Fed Reserve members, a bunch today as well. Again, the messages are pretty much being reiterated, and it's stuff that we knew. Meister out yesterday talking about that, well, you know, inflation's being a little bit more sticky. We're going to cut rates, but maybe not 3 times, might be 2 times. And so they're just repeating that same message and kind of falling in line now with this idea that inflation's been a little bit sticky. They need to see some more evidence of falling inflation before they start getting more aggressive with rate cuts. That's pretty much what we already knew. So they are kind of setting this up that we will not get a rate cut in June, could get a rate cut in September. So that's about kind of the way things are kind of panning out. Of course, they are also discussing the need to start reversing QT a bit here. That could start as early as June. So we've got a few things that are coming out, of course, FOMC minutes as well this week. So again, you know, the message is very consistent here from Fed members. A lot of that debate that we had going on last year about cutting rates and how many times and all that, that has pretty much devolved into a very steady message now from most of the speakers about inflation is coming down. It's just not coming down as fast as they would like. On that news, really yesterday, markets continued to rally here a bit. Now, again, markets didn't do a whole lot yesterday, but again, did continue to rally here. Finished about where we peaked the market a couple of days ago. So, again, the market's starting to consolidate here just a little bit after that big surge higher that we had, last week. Markets have just kind of been stuck here a little bit at this elevated level. Again, that's not surprising. Again, we've had a big move. We're very deviated from long-term averages, etc. So, again, the further you get away from these averages, the bit more difficult it is for the markets to continue to go higher without having some correction first. And as we talked about, previously, when the market's doing this, we kind of get these regular corrections, at least back to the 20-day moving average, and that's a very normal process. Even as markets are rising, you get these little 1-day, 2-day corrections back to the 20-day. Now, right now, that's a decent decline. To get back to the 20-day moving average, you'll have to go from 530 on the S&P to 515. So it's a 15-point drop on the S&P just to retest the 20-day moving average, which, by the way, did cross above the 50-day moving average yesterday. So again, that's one thing to note here, that kind of that bullish support is certainly there and continues to hold that level at this point. So again, there's nothing wrong with the markets here. Buy signals are in place, very overbought short term. Markets are looking to open a little bit weaker this morning. That shouldn't be surprising. A little bit of a correction here over the course of the next week or two. Bit of consolidation, bit of a pullback. Certainly shouldn't be surprising as well. So again, we're going to get that at some point. So again, just kind of be aware that if you've got some really large gains in your portfolio right now, need to do some rebalancing. This is a good opportunity. We've had a very nice rally from following that kind of April decline. We've had a very nice rally since that correction that we had. And so, a lot of gains back into stocks, and we've got a couple of important reports. So yesterday, Palo Alto Networks actually had a good earnings report. Nothing wrong with the earnings report. Outlook was in line with expectations, but the stock's trading down today because they didn't raise their guidance. And this is what we talked about earlier, is that the market's been very, brutal on companies that just don't deliver an outstanding report. So even though you said, hey, I'm expecting you to report this, and that's exactly what they deliver you, we're going to sell the stock anyway because it wasn't better than we expected. And that's been the real story behind this whole earnings season. Misses of earnings get really punished. Disappointment in outlooks gets punished. You have to fire on all cylinders to get a little bit of a gain out of the stock. So again, what that's telling you is that we've priced in a lot of the news into companies this season. So in other words, if we have any type of slowing in the economy, we're going to see a lot more disappointments in terms of outlooks. And again, that's going to put pressure on the overall market because the market is very well priced for perfection at this point. Again, there's nothing wrong with that, but we've just priced in perfection. You can tell that by how markets are responding to a really good earnings report. Again, Palo Alto's Networks report was very good. Outlook was in line with estimates, which was already very elevated. And again, stocks can be down today because they didn't raise guidance and come in a whole lot better. So again, just be aware of that. Also on tomorrow, I believe, if I'm not mistaken, we have NVIDIA reporting. That's the last of the Mag 7 that's coming out for the season, but they're going to report earnings tomorrow. We'll probably take profits in that stock today, just a little bit, just reduce that position ahead of earnings simply because of the Palo Alto network effect. In other words, NVIDIA comes out, they have a stellar quarter, but they don't announce a big surge in orders over the next quarter or two. Remember, this is a company that's been growing revenue at 100%, 200% quarter after quarter for the last several quarters. And so again, if there's any slowdown, all of a sudden that could lead to a fairly significant drop in the share price of NVIDIA. So we'll probably take some profits today ahead of that announcement tomorrow. Outside of that, the markets are doing fine. Again, there's absolutely nothing wrong. Okay, so here's what you need to know before the bell this morning. The big debate right now is in the SEC, and we saw this previously with Bitcoin in terms of the launch of ETFs surrounding Bitcoin. And when the ETF was approved for Bitcoin, we had this very big surge in Bitcoin prices because all of a sudden there was a lot of demand for Bitcoin as people buy the ETF. The ETF has to buy the underlying Bitcoin. So you had this very large surge in Bitcoin prices because of that launch of the ETF. Since then, Bitcoin's really not gone much of anywhere because now we're starting to see this just rotation between the ETFs. Money coming out of Grayscale, as an example, going into the BlackRock. BlackRock's money's leaving out of BlackRock to go somewhere else. So Bitcoin's just really kind of been stuck here for a bit. But now the SEC is expected to vote within this week about launching an ETF for Ethereum, which is the other major player. Ethereum had a very, very large jump yesterday in anticipation of the passage of that regulation to allow those ETFs to be issued. There's about a 75% probability this will go through. It's not 100%. So this rally could be very short-lived if for some reason the SEC does not allow Ethereum to do ETFs like they allowed for Bitcoin. But if we do get that, we could see another fairly sharp jump in Ethereum simply because of the same effect that we saw when Bitcoin allowed ETFs. All of a sudden, people had to buy the Bitcoin as people bought the ETF. So we could be getting a decent setup here for Ethereum in the short term. But again, that'll be a function of whether or not this could be very short-lived or not, depending on whether those ETFs are approved. So that's what you need to know before the bell this morning. When we come back, we'll get into why you shouldn't benchmark your index. Benchmark your portfolio against an index. I'll say that right in a second. Be right back on The Real Investment Show.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Welcome back to the show this morning. So it's probably about once a month, at least, if not more often. But I get an email from somebody saying, why should I hire an advisor when I can just, buy the S&P and, most fund managers don't beat their benchmark every year, right? And that's a true statement. Every year, S&P puts out a report that says, okay, here's all the active fund managers. This is how many beat their index this year. And generally, there's a significant number. It could be 60%, 70%, whatever it is, that didn't beat their index within a given year. And that's a very, very true statement, right? It's very misleading, though, because you don't compare. You're just looking at overall fund managers, and you're saying, okay, this many didn't beat the index this year, but some did. Well, the ones that beat their index last year may not have beat their index this year. Right? So it doesn't tell you about the performance of managers over time. It just tells you from one year to the next. And even if you go and say, okay, well, over the last 3 years, 50% didn't beat their index or whatever the number is. Okay, that's true. But within that 3 years, a singular fund manager beat the index 1 year, but then didn't beat the index the next year, right? So it's not a very valid, it's not really a good way to judge anything. But comparison is a profit motive driven by Wall Street. And comparison is the thing that keeps money in motion. And, you know, and we've talked about this before on the show, but let's say I bought Brent a Mercedes, right, for his bonus this year. So he was a very good employee this year, so I gave him a Mercedes. He's very happy, right? Brent, you're happy. You got a Mercedes. I know you drive a Miata, but if I gave you a brand new Mercedes, you'd be pretty happy, right?
Oh, yeah.
Okay.
I'd sell it.
Yeah, you'd sell it. That's fine. But I gave everybody else in the office 2 Mercedes.
Wow.
So now are you still happy about your 1 Mercedes?
I'm still going to sell it. I get your point.
But get my point.
Yeah.
Now, but see, you got a Mercedes, but now you're not happy because everybody else got 2, right? And so this is the whole thing about benchmarking, is that we're constantly measuring against something else. We're always worried about what somebody else is doing, the keeping up with the Joneses, etc. But shouldn't you be happy? I mean, if you get a Mercedes, you should be happy with the fact you got a Mercedes, even though he went and sold it. To drive his little Miata. I have no idea how this works, but anyway. But this is the point, and this is what Wall Street wants you to do, right? Instead of you being happy with the money that you make in a fund or whatever it is, or how you do in your portfolio, Wall Street always wants you to compare, and they want you to compare to some, kind of random benchmark index that says, well, you did okay last year, but you didn't beat the index. And so now you're in kind of a panic frenzy to go move your money around somewhere else to, find out who was hot, right? So now you go in reverse and say, okay, well, if Brent only got 1 Mercedes last year, what other employee got 2, right? So let's go put our money with that guy. And, the problem with that when it comes to investing is that, well, 1 year, emerging markets was really hot. And so a large cap blue chip fund manager is going to underperform in a year where emerging markets are really hot. And so you go invest in emerging markets. Let's take a better example. Gold right now is really hot this year, right? It's on fire. It's doing fantastic. And gold does this from time to time. And that performance could last for a year or even 2. But eventually, gold, because it's a commodity, has very, very big reversions. And we've seen this recently with cocoa and coffee and others where they've lost 50% of their value in a very short period of time because it's a commodity. And so when the NYMEX traders are trading that commodity, they're using leverage futures to do that. That's spot gold, right? That can cause the price to move very quickly when those positions start getting unwound. So this year, gold is doing fantastic. And so it's like, well, I want to be long gold. And so, last year, I was long stocks. So this year I go buy gold. Well, that's fine. And right, you'll do fine this year. But next year, gold has a big correction and some other asset goes on a big tear, whatever it is, right? And we go through these cycles all the time, right? Markets are always cycling. What was at the top of the performance chart 1 year is almost always near the bottom of the performance chart in the next year or 2. Generally, nothing stays at the top of the performance chart for more than 2 years in a row. And Callan does a great example of this by looking at a periodic table of returns over long-term history. And you'll just see this over and over again. What's hot 1 year, down at the bottom next year, And then what was at the bottom last year is at the top this year. So it's just, and that's just the way markets and cycles work. And you should just expect that as part of that. But here's the important part is that when you're measuring this benchmark, right? You go, well, you underperformed that benchmark last year. So people go and they buy what worked last year, right? Just in time to be in the asset class you shouldn't be in this year because of rotation in the markets. But that's what happens. But see, the reason that Wall Street wants you to compare all these things and it's like, oh, well, how'd you do relative to the benchmark index? Is because that creates disappointment. Now you're upset. Brent's upset now because he only got one Mercedes and he's going to go look for another job that'll pay him 2 Mercedes. And so, the reason that Wall Street consistently starts creating more and more benchmarks or other things for you to compare to is that comparison causes you to move money. When you move money, that creates fees and revenue for Wall Street. So the more benchmarks and things that I can get you to compare to, the more I can get you to move money around to create fees and revenue. But is it really good for you? Right? This is the whole point. And so when you start looking at this benchmarking index, I got a great email yesterday from a gentleman. It says, here's my situation. He says, I'm with this manager, and I forgot where it was, Dallas, I think. And, my performance is about 3.5% year to date. The market's up 12. I'm very unhappy. Okay. Well, there you go. This is exactly the story that I'm talking about here. He's up 3.5. He's upset because the market's up 12. And he's like, okay, well, why am I not making money? I go, well, how's your portfolio allocated? Well, he says, I have this much in bonds. I've got this much in this. I've got this much in that. I go, well, that's the reason. You're not built like the S&P, but you're comparing yourself to the S&P. And so if you want to be like the S&P, you have to look like the S&P. And so this is one of those issues. So, but here's this comparison, right? I'm unhappy because I look at television, the S&P's up 12 and I'm not. So now I'm unhappy because everybody, I want more, right? We're inherently greedy as individuals. We want whatever's working. But is that good? Now here's the question we have to ask ourselves. Is that good for you? Because if I want to be like the S&P, I have to invest like the S&P, which means I have to take on the risk of the S&P. And is that a good thing? Is that really what I'm wanting to do? So these are the considerations, and we're going to get into the breakdown of the S&P here in just a second and talk about that. But the thing that we have to ask ourselves is what is our investing goal? What is our job? What are we trying to do? Now set all the other stuff aside for a moment. Set aside geopolitics and domestic politics and set aside inflation and everything else. Forget all that for a moment, right? Plenty of reasons to scare the bejeebers out of ourselves. What's our reason that we invest? That's it, right? Why do we invest our money? Because our money that we're investing is our savings, right? We're investing our savings. So is our goal with our savings to try to get rich? Is that our goal? Or is our goal with our savings to make sure that our savings grow and adjust for inflation over time so that we have the same purchasing power in retirement that we have today? And that's the thing to remember. And so over long-term time frames, we talk about 20, 30, 40, 50 years of, which we have to save and invest for our retirement. What's our goal, right? What are our needs? Those type of things. And do we want to take on that kind of, and how much risk are we willing to take on? And again, this goes back to your concerns about the world, right? Based on your views, how much risk are you willing to take to grow your money? And is the S&P 500 that we see on television 24/7 and on our phones and on every website on the planet, but is the S&P the benchmark that we should be using? And so this is the question we have to delve into. So when we come back from the break here in a second, we're going to get into the S&P, the benchmark S&P, right? And we'll talk about a few factors of this benchmarking as a function and the way to understand it better, and then to also understand about why you shouldn't benchmark to begin with. It's a terrible idea that was invented by Wall Street to get you, again, comparison. It's the root of all evil when it comes to managing money, and it leads to the most mistakes. The biggest mistake generator that you can do with your portfolio is to benchmark against any index. You should never do that. But we do it all the time, right? Because that's what Wall Street tells us to do. And first thing we do is we say, well, what's your track record over the last 1, 3, 5, 10-year period, right? How did it do versus the S&P? Terrible. Because that's what traps you into that money in motion scheme to generate fees for Wall Street. Be right back after the break.
Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Food in total is now making up 30% of the average discretionary income.
I believe it. I mean, that is our largest expense is food.
Yep.
And we rarely eat out.
The Real Investment Show podcast.
Our biggest frustration at home is how do we do this cheaper?
Yeah. No, I agree. We're running Hunger Games at our house.
At realinvestmentadvice.com.
So, if you can make it to the table without getting killed, you get to eat.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So, two things. First of all, I want to wish my wife happy anniversary. I love you, babe. It's been a great ride so far. I'm just hoping it'll be over soon. In other words, I'm going to die. No, it's been fantastic. My wife is just one of those phenomenal people. If you ever meet her, you will know what I'm talking about. She's just a very terrific person. Anyway, it's our wedding anniversary today. She's traveling. She's been in Amsterdam for the last week and a half. So she actually left on my birthday, and then she's coming back on our anniversary. So
Dutch treat.
I know, right? There you go. So anyway, couple of things here. Talking about benchmarking, and Jim Tyler in our chat makes my point for me, right? He says, the guy should be, so we were talking about this email I got from a gentleman. He's, up about 3.5% for the year so far. And he's upset because the market's up 12, right? What should he do? Well, Jim says he should be upset because he's up 3. He could have gotten 5% in a money market fund. Well, that's that right there. That's the problem with benchmarking, because 5% is annualized in a money market account. So in other words, over the course of an entire 12 months, you'll get 5%. So if you're looking at 3.5%, and let's just call it 6 months in because we're almost, into June. At 3.5%, that's a 7% annualized rate of return. So yeah, he's beating the money market fund, right? Because 5% money market is a full 12 months, not to date. To date, money markets are up 2.5%. So, but see, that therein lies exactly what I'm talking about. See, this is a perfect example of what I'm talking about when it comes to benchmarking, is not understanding the benchmarking process and what you're actually benchmarking against. And so this goes into the S&P 500. So if you take a look, and this is actually in the article. So if you go to our website, all this is in the article today that's on the website, by the way. I've got all the stats for you there as well, but we'll kind of go through these. But if you take a look at the concentration of the S&P, the top 10 companies, or actually the top 7 companies in the S&P, have a market cap of $12.3 trillion. So you've got a market cap in the index of $12.3 trillion in just 7 stocks. That is more than 4 times the size of the Russell 2000 index in its entirety, which is 2,000 stocks. So you've got 12 stocks valued at a higher level than 2,000 stocks in an entire index by itself. And so this is, what we've written about previously, and this is partly because of passive indexing. And look, the reason that advisors so heavily push passive indexing today is because they can't manage money, and that because it requires time and effort and discipline and a lot of other things. And they just want to bring you in, sign you up as a client. They put you in a basket of ETFs, just buy and hold, you'll be fine over time, kind of ride the market up and down. And that's fine. There's nothing wrong with that, but there's been this massive push into that mode, right? Just putting people into an S&P ETF or some passive ETFs and just holding them and not actually managing the risk. And we can see that because, over the last really kind of 10 years and particularly 15 years, the rise of passive ETFs versus other funds has just been astronomical. So there's just been this massive money flow into these ETFs. Well, there's a consequence of that, because when I this is like I was talking about earlier with the ETF Bitcoin ETF, is that when that comes to fruition, everybody that buys an ETF, that ETF has to buy all the underlying companies. And so you have this consistent money flow into these companies based on that passive index. So right now, if you every time you put $1 into the S&P index, it takes about 35 cents of that dollar goes into just 10 stocks. The other 65% gets divided between the other 490 stocks, and that's the top 10, right? As I said, if you take a look right now at the index of the Magnificent Seven itself, that market cap is nearly 28% of the entire index. So 7 stocks make up just a massive chunk. So every time that you're putting $1 into an ETF, that's where the money's going. So here's the problem with benchmarking. If I'm going to benchmark against an ETF, I've got to have 35% of my money in those 10 stocks. And most people don't want to do that. Most people don't want 35% of their money in just 10 stocks because you're taking on a lot of risk, right? And so but if you don't have that, odds are you're not going to beat the benchmark index. And that's where we start getting into this whole comparison related issue, right? But beating the index itself is a very difficult feat to achieve. Only 2 people have beat it long term on a consistent basis: Bill Miller and Peter Lynch. Bill Miller was with Legg Mason Value Fund, and Peter Lynch was Fidelity Magellan. And those guys beat the S&P 500 numerous years in a row. In fact, Bill Miller kind of set the record. He beat the S&P 500 15 years running. The odds of beating an index for 15 years in a row is 1 in 2.3 million. The reason is because styles are rotating within the index. Things are changing all the time. And after that 15-year streak, Bill Miller's track record fell apart because the market's changed. And so you can be hot for a while, right? And you can beat the index. And this is where we build a lot of overconfidence in ourselves. And it's like, oh, we're killing the index. And then the market changes for one reason or the other. What was hot is not hot now. But a well-managed index, a well-managed portfolio can outperform the S&P over the long term, right? It's just not going to beat it every single year. There's going to be some years that you underperform. There'll be some years that you outperform. But over the long term, you will beat the index. And look, even if you just buy an and I told you I was going to talk about the differences between index and you. Even if you just buy an index, if you buy an S&P 500 ETF, right? So you buy, and you'll just have to show that chart, Brent. So if you just buy an S&P 500 ETF, you still won't beat the index. Because first of all, you're just now the index, but you're still going to underperform the index because the ETF you pay a fee for. The index has no fees. It pays no taxes. It has what's called replacement. It benefits from buybacks. These are things that you don't benefit from. Replacement in an ETF is this. Let's say that the index owns 100 shares. A great example of this was during the financial crisis when GM went bankrupt. You own 100 shares of GM in your portfolio. The index owns 100 shares of GM in its portfolio. Just for math terms, GM didn't go to zero, but let's just say it did, right? So you have a company in your portfolio, goes to zero, goes bankrupt, goes out of business. It's Lehman, right? So your 100 shares is worth zero. The index takes the 100 shares of GM out of their portfolio and just takes 100 shares of another stock in, and immediately the index rebalances, and there's no differential to the index because it's just measuring price and shares outstanding, market capitalization. Your portfolio, however, if you want to go back to replicating the index, you have to either contribute more money to your index because that 100 shares of GM is no longer there, right? That you lost all that money. So you've either got to put more money into your index or you're now going to underperform because you can't just swap a stock at no cost. The index can. So there's a lot of things that are in an index that it doesn't have that you do. Taxes, fees, replacement costs, share buybacks, all these other factors. Because the index is based on market capitalization, your portfolio is based on dollars invested. So it's a big difference. But even if you own the ETF, you're going to underperform, like I showed you, because you're paying a fee, which the index doesn't have. So you're still going to underperform. But here's the real point about this. It doesn't really matter, because I just did a really quick search. I did a quick search of actual mutual funds, right? Highest cost mutual funds that have had very long track records going back 20, 30, 35, 40 years. Been around forever. And I said, just give me the 5 biggest. Every one of them beat the S&P 500 over that time frame. Some of them absolutely crushed it over that time frame. American Growth Fund, Sequoia, Fidelity Contra Fund, Dodge & Cox Growth Fund, Pioneer Fund, absolutely killed the index. Did they beat the index every single year? Absolutely not. So when the SPIVA comes out and says, well, active mutual fund managers, 70% didn't beat their index last year. So what? Who cares? Have they beat it over time, which is what we're concerned about? Not over 1 year or 3 years or 5 years. Have they beat it over time? Because that's your goal. Your goal is to grow your money. Who cares about the index? The index has nothing to do with your portfolio and the things that happen inside of your portfolio. Forget the index. Measure what's important, which is the rate of return you need every year to get to your goals. All right, be right back after the break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So welcome back to the show this morning. Got an interesting email from a gentleman yesterday talking a little bit about corporate greed, I guess is the way to put this, right? So, when you take a look at wage disparities between executives of corporations and workers, there's a big gap, no doubt about that, right? And this all stems from the late 90s under Clinton, when Bill Clinton decided he wanted to cap executive salaries at $1 million. His heart was in the right place. The idea was badly structured because immediately Wall Street went to work and said, okay, how can we compensate executives if they're capped at $1 million in salary? And we came up with stock options, which has been a bigger boon to the executive C-suite than any other salary structure. If Bill Clinton would have left it alone and just restricted stock option buybacks, we would have been much better off. Because companies can only spend so much cash, right? There's only so much cash to spend, so I can't just keep burning more and more cash to my executives. It's just not there in a lot of cases. I don't have that kind of revenue. Right? And so salaries are generally capped by the amount of revenue you have. But stock options, right? I can just issue those out to the wazoo because there's no cost to that to issue them. There's a dilution, but there's no cost, right? So I'm virtually uncapped. And this has led to this massive increase in executive C-suite corporations versus the employees. I get that and completely understand it. Here's the problem with that analysis. We're only looking at 10,000 companies out of 6 million. It's 0.01%, which ironically ties into the wealth gap of the 0.1% versus everybody else. I get that. But the problem with the solutions is problematic. I shouldn't say the problem with the solutions. There's a problem with trying to solve that problem. Because the thesis is that we need to fix it everywhere. But it's not a problem everywhere. It's only a problem in publicly traded corporations, primarily just the largest publicly traded companies. It's not really even a problem in small and mid-cap companies because they don't do a lot of buybacks. They don't do a lot of stock option issuance because they don't have the capital to do that with. It's mostly what we're talking about is out of those 10,000 companies, we're now down to maybe 1,000 companies that are the problem with this perceived wealth gap in the economy between the executives and the workers. And I'm not saying it doesn't exist because it does. But let's bring this back home a bit and talk about the other 6 million businesses out there that are running their business. They've generally about 50% of those have fewer than 10 employees. So are we going to so the thesis is well, we just need to cut executive pay and we need to make it equal for everybody else, right? And that's generally the premise of some sort, right? We just need to limit the pay to the executives and pay the workers more. In theory, it sounds great. Reality is very different, particularly when you get into small and mid-sized companies and particularly private businesses that are out there operating. Here's the problem with a private business that is overlooked in this whole analysis. I own a business that has 10 employees. I have promised them wages that I am legally obligated to pay them. If I don't pay them their wages that I have promised them and that they have agreed to, we have a contractual relationship. If I don't pay them their wages, they can sue me, right? We have labor laws. So what that means is that if my business doesn't make enough money this month, I don't get paid. My employees get paid. I don't. And if you've ever run a small business for any length of time, and I've run many, trust me, there are months where you don't get paid. Everybody else gets paid, but you don't. And that's just part of running a business. But there's also the benefit of being the owner of the business, which is this. Labor has a finite value to it. The one thing that we have misconstrued in society recently is that labor has a higher value than it does, and it doesn't. If you want to make money, you own the business. Owning the business allows you to create the revenue. You control your cost, including labor, which leaves you a profit margin from which you get paid. See, the owner of the business only gets paid from the profit of the business, ultimately. Vendors have to get paid first. Employees get paid. IRS gets paid. Everybody else gets paid before the owner of the business. The reason the owner of the business has the opportunity to make the most money is because he took all the risk. He's the one that put up the capital for the business. Risk losing it all. He's the one that's willing to do the work in the business and not get paid for it because it's his business. If you're just an employee, you get paid. You don't take any risk. So the value of labor is capped because you're getting compensated for a no-risk investment in that business. Yes, you could say your risk is the business goes out of business and I lose my job. That is true. There is that. That is a risk. But labor has a cap. The value of that cap is the value that you bring to the business. And this is one of the big mistakes with minimum wage discussions. We've talked about this before. Your minimum wage is zero. Your minimum wage is what value you bring to the table. If you come to my business and you bring me an excellent skill set that increases my revenue, I'm going to pay you more. And you're going to be able to demand more for your labor because you have brought a value to the business that increased the overall revenue to the business. But see, this isn't the problem that we're talking about, right? We're only talking about really, honestly, the 1 to 2,000 companies that are creating this massive wage disparity, appearance of massive wage disparity because of stock option-based compensation, share buybacks, which, as we told you before, share buybacks are not a return of capital to shareholders. The thesis is that when a company buys back their shares, the price goes up, but Apple's a good example of this, right? They were buying back shares, stock price was going down. That doesn't mean it always works. Share buybacks are a direct benefit to insiders of the company who sell their shares. So what is a share buyback, right? So the company is buying shares back. You can sell your shares to, on any day of the week on the open exchange. When Apple does a buyback, did Apple call you and say, hey, I want to buy your shares back? Did you get a letter in the mail? Did you get a phone call from an Apple representative saying, hey, I want to buy your shares back? So where's this $110 billion in buybacks that Apple's going to execute? Where are those shares coming from? Yes, they can retire some from the open market. A lot of them are being retired by insiders selling their shares back to the company. In fact, an SEC study, Securities and Exchange Commission study, proved that. They did the analysis, they did the look, and they did the work, and they said the majority of share buybacks are executed by insiders. So so if you want to solve your wage disparity issue, you've got to be very careful. Because if you pass some random law that says the employees have to be paid the same as the executives of a company, you're going to wipe out 6 million small businesses almost immediately. You want to fix the wage disparity problem? No more share buybacks, no more stock-based compensation. If you want to pay your executives, you pay them out of cash, just like everybody else. There's only so much cash. Will executives at JP Morgan and Amazon and others still be making millions of dollars every year? Absolutely. They probably deserve it, though. Jeff Bezos created Amazon. He deserves to be paid a lot. Elon Musk deserves to be paid a lot. The guy's a genius. Right? They deserve the money that they make. They are benefiting from capitalism, right? But there's only so much cash. You can still pay them millions of dollars every year, but there's a limit to the amount of revenue that these companies make that simply the board will say, hey, we want to pay you $55 million a year, but we don't have it, right? I can do it with stock-based compensation, stock options, grants, those type of things, restricted stock, all those type of things. I can do that. You get rid of that, you solve your wage disparity problem to a large degree. But see, this is the problem with all of these emotional topics, right? Minimum wage. We need to pay a minimum wage to the 3 million people that are working minimum. No, minimum wage is a starter salary. It's a tester salary. It's to allow you to get the opportunity to get experience. If you're good, you work your way up out of minimum wage very quickly, right? Emotional, CEO pay, very emotional. But bad policy can destroy the fabric of capitalism if you're not careful. All right, wraps up the show for the day. All right, have a good day. We'll be back tomorrow. Danny Ryloff joining me in the morning, and we'll talk about earnings tomorrow as well. We've also got a good bit of economic data and Fed speeches today. And then, like I said, on Wednesday is NVIDIA. That'll be the big earnings run this week. So, all right, have a great day. We'll see you back here tomorrow. Get by the website, get our latest blog post, and, of course, like this channel. We appreciate it. See you tomorrow.